Today we will run into why Nike's stock tanked since 2021, why one strategy led to this massive failure, and how the company now pulls the trigger to push back to all-time highs. Hi, this is Stocks in the Wild. We analyze and research interesting stock opportunities for boosting your portfolio. Before 2020, Nike was heading into a golden future. The pandemic was playing in good faith for Nike. Due to the lack of other public activities, people started working out more and more at home or going out for a run. As the home gym hype took off with companies like Peloton, people also needed matching sportswear. This isolation pushed the whole sports and activity industry to new highs, and after the first shock, Wall Street realized people are buying more and more online. Therefore, Nike's revenue growth was chasing records. In the fiscal Q4 of 2021, Nike's revenue were $12.3 billion, up 96% compared to the year prior and increasing 21% compared to the fourth quarter of 2019. Compared to the fiscal Q4 of 2014, Nike's revenue were $12.6 billion, down 2% compared to the last year. In the meantime, the competition felt not asleep, and fresh new upstarts like Hoka and On entering the markets. Especially On were founded by athletes for athletes and revolutionized the running shoe with their cloud tech with its Swiss-made glamour. Hoka, on the other hand, with their big shoe sole, hits the sweet spot of stylish and trendy. And also legacy brands like New Balance with their classic old dad vibes, or Asics, who trusted their customers to try something new. So let's analyze Nike's main strategy flaw. Imagine, the pandemic is still running, people are buying more and more online, every product you sell outside of your own store, like via Foot Locker or Walmart, take a good chunk of your margin. Well, therefore Nike went all in the online business, cutting off decade-lasting business relationships to commercial retail stores to focus only on your online store. Unlike Nike's XX, customers were drawn into classic offline stores after the first 1.5 years of the pandemic. The hunger of real life store experience and just walk by shopping let Nike stock tank to price levels of 2020 and even 2018. Additionally, Nike's presence to customers is declining due to the lack of being on their minds. For instance, Brandon Eng's running group in Portland, Oregon was roughly quadrupled in size since 2021 to about 80 runners. And that doesn't include the representatives from New Balance, Hoka or Asics who regularly show up at these events to let runners try their new sneakers or give free merchandise and even pay for drinks after the workout. The consequences are running and sport-hungry customers are pulled away from the swoosh to fresher, more innovative brands. So the gap fillers like Hoka, New Balance, Asics and On took the risk of trying out new shoe soles and are more omnipresent in every store, no matter of online or offline, flagship or retail store, and most important for the athletes, with the athletes at the running clubs. In September, Nike turned the tide and pulled back its ultimate veteran, Eliot Hill, as new CEO. Eliot Hill started working at the sneaker giant in 1988 as an intern, taking calls from customers and moving boxes in a warehouse. Over more than 3 decades, he climbed to be one of its top executives. His strong brand loyalty and business relationships with retailers could bring back Nike into the stores. Additionally, he could push back the company closer to the sport community and bring back its old glamour like Adidas did this year with its classic Samba hype. Nike's stock jumped up by 6% after the new CEO announcement, since Hill has such a long company history and strong commitment to the brand. Nonetheless, the stock was tanking, resulting in minus 52% since its last all-time high in November 2021. Therefore, now its price per earnings ratio is just around 21, which seems kinda cheap for such a global player. But as mentioned earlier, Nike's cut with the dealerships of offline commerce partners was conceived as pretty bad strategy. No one knows if Hill can fix this and how much of their margin they have to pay to Foot Locker or Walmart in order to get back into the game. If Nike's willingness to fight back is strong enough, we see high upside potential in the current stock price at around $80. But keep in mind, the short-term risk of new fresh startups eating into Nike's core business, the runners. If you find this video was insightful, please leave a like, comment or subscribe. Thanks and see you in the next video.